The Trump administration's imposition of a 145% tariff on Chinese imports aimed at boosting domestic manufacturing has significantly escalated trade tensions between the United States and China. In retaliation, China has imposed a 125% tariff on U.S. goods, intensifying fears of a global economic slowdown. Despite these tariffs, the U.S. government has announced a strategic exemption for certain electronics, including smartphones and laptops. From these tariffs, this decision benefits major tech companies like Apple, Samsung, and Nvidia, which rely heavily on Chinese manufacturing, and aims to prevent consumer price surges. Analysts suggest that relocating production to the U.S. remains economically impractical for these firms. The exemptions have provided some relief to the tech sector, which had experienced a substantial market value drop. However, broader economic concerns persist, as reflected in declining U.S. consumer confidence and market volatility. The University of Michigan's Consumer Sentiment Index reported a significant decline, highlighting fears of job losses and inflation. Meanwhile, the sell-off of U.S. government bonds indicates waning investor confidence in the U.S. economy. The trade conflict has also impacted global markets, with South Korean stocks declining and major U.S. indexes experiencing losses. Despite the tariff exemptions, the Trump administration continues to push for reduced reliance on Chinese manufacturing, citing national security concerns. This ongoing trade war underscores the complex interdependencies of the global economy and poses significant challenges for policymakers, businesses, and consumers navigating the evolving landscape.
The latest report from Redfin highlights a significant financial gap between U.S. homeowners and renters, with homeowners needing to earn approximately $50,000 more annually than renters to cover shelter payments. Specifically, an annual income of $116,633 is required to afford a median-priced home, compared to $64,160 for renting a typical apartment. This disparity reflects the rapid increase in home prices and mortgage rates, which have remained above 6% for 2024 and 2025. The income required to buy a home has surged over 82% since 2021, underscoring the growing affordability challenge in the housing market. The volatility in mortgage rates is closely tied to movements in U.S. Treasury yields, with the 10-year yield recently climbing to 4.50%. This rise in yields, driven by inflation fears and economic uncertainty, has pushed mortgage rates above 7%, further complicating the housing affordability landscape. Despite these challenges, there has been a recent uptick in mortgage applications, suggesting some recovery in home buying activity. However, ongoing concerns about tariffs and recession risks continue to weigh on consumer sentiment, potentially impacting future housing market dynamics.
A group of U.S. senators has called for an investigation by the Securities and Exchange Commission, SEC, into potential insider trading by former President Donald Trump and his associates. The inquiry request stems from Trump's recent activity on his social media platform, Truth Social, where he posted, "This is a great time to buy," just hours before announcing a 90-day suspension of additional tariffs against several countries. This announcement led to a significant stock market rally, marking the best performance for the S&P 500 since the recovery from the 2008 financial crisis. The senators, led by Elizabeth Warren, are particularly concerned about whether Trump or White House insiders had prior knowledge of the tariff suspension and used this information to benefit from stock trades. The SEC is being urged to examine whether Trump's actions constituted market manipulation or insider trading, particularly concerning the timing of his post and subsequent tariff announcement. The letter from the senators highlights the potential for administration insiders, including Trump's family or donors, to have profited at the expense of the general public. The incident has raised questions about the integrity of market operations and the potential for abuse of privileged information by those in positions of power. The shares of Trump's media company, Trump Media and Technology Group, notably surged by 21.67% following the tariff news, adding further urgency to the call for a thorough investigation by the SEC into these allegations.
Federal spending under President Donald Trump's second term has surged by $154 billion despite efforts by the Department of Government Efficiency, DOGE, spearheaded by Elon Musk to cut costs. The Wall Street Journal analysis, based on Treasury Department financial statements, reveals that this increase is primarily driven by mandatory expenditures such as Social Security, Medicare, Medicaid, and rising interest payments on the national debt. Notably, Social Security expenses alone have risen by $32.7 billion, attributed to an increase in beneficiaries and a cost of living adjustment, while Medicare and Medicaid have collectively added $29 billion due to higher enrollment and healthcare costs. Elon Musk's aggressive cost-cutting measures, including job cuts and program rollbacks, have reportedly saved $150 billion. However, these efforts are overshadowed by the mandatory spending increases and legal challenges that have hindered more significant fiscal impact. Legal disputes, such as those involving the firing of probationary employees and blocked foreign aid cuts, have limited the immediate financial benefits of DOGE's initiatives. As a result, the administration's narrative of fiscal responsibility faces scrutiny, with federal salary payments and interest costs continuing to rise, complicating efforts to materially reduce overall expenditures.
Cuban authorities have recently informed foreign companies operating in the country that they are prohibited from repatriating foreign currency currently held in local bank accounts. This move has sparked significant discontent among the affected businesses, some of which have escalated their concerns to their respective governments. The Cuban government is offering an alternative through a new type of foreign currency bank account, which is part of a restricted pilot program. These accounts are theoretically immune to the liquidity issues plaguing the Cuban banking system, but they only accept new capital from abroad, leaving existing funds frozen. This development is set against a backdrop of severe liquidity challenges in Cuba, exacerbated by the pandemic, U.S. sanctions, and ongoing economic mismanagement. The Cuban financial system, entirely state-owned since 1959, is struggling with undercapitalization and limited access to foreign currency. The state's monopoly on foreign trade, combined with its reliance on imports for 80% of consumption needs, has led to prioritization of essential goods like fuel and food. The new banking measures aim to attract foreign currency into the economy, but skepticism remains due to past experiences with unstable monetary policies and economic reforms. The situation underscores the precarious state of Cuba's economy and the complex dynamics foreign companies face when operating within it.
UK lawmakers convened an emergency parliamentary session to deliberate on legislation aimed at rescuing British Steel's Scunthorpe plant, the last facility in the UK capable of producing steel from raw materials. The plant, owned by China's Jingye Group, is facing closure due to financial unviability, risking the loss of 2,700 jobs and threatening the UK's industrial capacity. Prime Minister Keir Starmer's administration is considering taking control of the plant to prevent the shutdown of its blast furnaces, which are crucial for industries such as construction and rail transport. The emergency bill, expected to pass, allows the government to mandate the continued operation of the plant's assets and includes provisions for potential state intervention. The situation underscores the broader challenges facing the UK's steel industry, which has been under pressure from cheaper Asian imports and past U.S. tariffs under President Trump. The potential closure of the Scunthorpe plant signals a significant risk to the UK's economic security and industrial strength. Business and Trade Secretary Jonathan Reynolds emphasized the strategic importance of maintaining domestic steel production capabilities. While the bill does not immediately nationalize the plant, it keeps state ownership as a possible option. The government's decisive action reflects the critical nature of the issue, marking the first Saturday parliamentary session since the Brexit vote in 2019.
NVIDIA, a powerhouse in the AI sector, has seen its stock surge by 1,610% over the past 5 years, largely due to the booming demand for its graphics processing units, GPUs. Despite this impressive growth, NVIDIA's shares are currently trading 24% below their all-time high from January, amid broader market volatility. The company's fiscal 2025 fourth-quarter results highlight its dominance, with 91% of revenue coming from the data center segment, driven by the need for advanced computing solutions to support AI models. NVIDIA's revenue soared by 78% year-over-year, reaching $39.3 billion, as cloud infrastructure providers ramp up their AI capabilities. NVIDIA's competitive edge is fortified by its rapid innovation in GPU architectures and its CUDA software platform, which locks in developers and creates significant switching costs. However, the company faces potential risks from top clients like Amazon and Alphabet, who are developing their own AI chips, and from macroeconomic factors that could lead to reduced AI spending in a downturn. Despite these challenges, NVIDIA's current forward price-to-earnings ratio of around 25 suggests a potentially attractive entry point for investors looking to capitalize on the AI trend, even amidst uncertain market conditions.
The core financial event discussed is the significant profit growth driven by artificial intelligence, AI, for two major tech companies, Amazon and Alphabet. Both companies are leveraging AI not only to enhance their operational efficiencies, but also to expand their revenue streams by offering AI products and services to external clients. This trend underscores the transformative impact of AI across various sectors, particularly in e-commerce and cloud computing, where these companies are already dominant players. Amazon, through its e-commerce operations and Amazon Web Services (AWS), is utilizing AI to optimize delivery routes and streamline fulfillment center operations, leading to cost reductions and improved profitability. AWS, the leading cloud services provider, is capitalizing on the AI demand by offering premium AI products and services, contributing to its impressive $115 billion annual revenue run rate. This dual strategy of internal efficiency and external service provision positions Amazon for sustained growth amid the ongoing AI boom. Similarly, Alphabet is enhancing its core business operations, particularly Google Search, with AI. The company has developed Gemini, a large language model, to power its AI initiatives, which is instrumental in refining its search engine capabilities and enhancing advertising efficiency. Google Cloud, another key player in the AI market, reported a 30% increase in cloud revenue, driven by demand for AI infrastructure and generative AI solutions. This positions Alphabet as a formidable contender in the AI space, with significant growth potential as it continues to attract new clients and secure substantial deals. Both companies exemplify how strategic AI integration can drive substantial business growth and make them attractive prospects for investors focused on long-term AI advancements.
BlackRock's first quarter of 2025 earnings reveal a slowdown in the momentum of its digital asset investments, particularly in its flagship iShares Bitcoin Trust ETF, IBIT. Despite the ETF's historic launch in 2024, which amassed over $50 billion in assets under management, recent net flows have dwindled to $3 billion from $18 billion in the previous quarter. This deceleration highlights a shift in investor sentiment, with a growing preference for money market funds and cash amidst market uncertainties. Larry Fink, BlackRock's CEO, acknowledged the challenges in his annual letter, emphasizing the potential growth in European markets and the need for more retail investor engagement. The broader market context has also contributed to the subdued enthusiasm for digital assets. Recent volatility in bond markets, compounded by geopolitical tensions and shifting trade policies, has created a complex environment for asset managers. While BlackRock shares saw a modest rise of 2.33% post-earnings announcement, they remain down by 10% year-to-date, reflecting the cautious market sentiment. Fink's tempered outlook on digital assets, coupled with the ongoing economic uncertainties, suggests a cautious approach moving forward, with potential opportunities in underpenetrated markets like Europe.
The financial landscape in 2025 is challenging, with the S&P 500 down 18% and the Nasdaq Composite in a bear market, exacerbated by President Donald Trump's announcement of historic tariff hikes. Amidst this turmoil, Dollar General, DG, has emerged as a standout performer, with its stock price up 16% this year, showcasing its resilience to economic downturns and tariff pressures. Unlike most retailers, Dollar General's business model, heavily reliant on consumables, provides a buffer against tariffs, as only about 10% of its inventory is exposed compared to Dollar Tree's 50%. This strategic advantage, coupled with its appeal to budget-conscious consumers during recessions, positions Dollar General as a robust investment. Despite recent struggles with market share and margins due to inflationary pressures, Dollar General is implementing a back-to-basics strategy to enhance operational efficiency and supply chain management. The company's history of positive same-store sales growth, excluding a slight dip in 2021, underscores its capability to thrive across economic cycles. With a P/E ratio of 17 and a dividend yield of 2.6%, Dollar General presents an attractive opportunity for investors seeking stability amidst economic uncertainty. As the market grapples with the implications of Trump's tariffs, Dollar General's recession-resistant nature and strategic initiatives could enable it to outperform in a weakening economy.